for our next panel, we have another very important theme, the importance of sustainable investments. And to moderate this panel, I'd like to invite Mariana Oiticica, partner at BTG Pactual, and with the participation of Guido Veul, portfolio manager from Goldman Sachs, and Mr. Oscar Young, portfolio manager for Impax. Thank you guys for your presence and good panel.
Well, it's a pleasure to have here Guido and Oscar. They are both portfolio managers from sustainable funds, which are funds that focus in investing in companies that aim, of course, to have returns, good returns, but taking into consideration ESG factors. So to start the discussion, I would like you guys to give a brief introduction of what you do and how you do. Guido, if you can start.
Yeah, oh, it's working. Thank you, Mariana, and good morning to you all, or bom dia, which is the two of the three Portuguese words that I know, next to obrigado. So bear with me in English, please. And it's a pleasure to be here today and see a room so full of people. My goal today really is here to share some of the characteristics and trends that we see in sustainability investing, and hopefully also to get you more excited about allocating to sustainable equity funds in your global equity allocation. And on top of that, maybe there's also a bit of a personal reason. I live in the Netherlands, and my house is in Amsterdam. It's at 3 meters below sea level at the moment, and we've got dikes to protect us. But we all need to fight climate change, because if that continues as it is going the way now, then my house will be a swimming pool. So we can all play our role a little bit here. Well, moving back to investments, I sit in what we call our sustainable and impact equity team, and we're based in the Netherlands as well. And we've got around 20 people, and we manage global and European sustainable equity funds, and we also have a number of more thematic impact funds. And we've been doing this for more than 20 years. Our flagship global sustainable equity fund is more than 20 years old. And I think sustainability is an important subject in the Netherlands and in wider Europe, but I think the most important reason we've been able to grow our assets in these 23 years, and we're still there, is that to us it's always been about combining sustainability with financial returns as well. Because our clients love sustainability, but if you don't get them the performance versus mainstream benchmarks, like the MSCI World, then they will leave. And so we've always been focusing on using sustainability as a tool to get better insights in companies and to identify long-term winners. And you can qualify our approach as centered on quality. We've always liked high-quality companies with an eye on their long-term success, with strong financial numbers, with a proven history of earnings growth. And to us, sustainability is a natural extension of this quality mindset. We like companies with management teams that focus on the long run, not the next set of quarterly results, but that's really our thinking when it comes to investments, when it comes to strategic company decisions, and how will I still be successful in 5 years' time, in 10 years' time, maybe even longer. And I think the way to do that is to take into account ESG risks and ESG opportunities. And especially on the ESG risk side, we've seen a lot of examples where you can really get significant financial impact as well if you don't manage them well. And I think we all know what happened to BP, the oil major, in 2010, for example. There was this massive oil spill in the Gulf of Mexico, and within a month the company lost 40% of its share price. And then some people will say, really bad luck for BP. But to us, this was not a big surprise, because we already noticed a trend. Prior to 2010, BP already had a string of smaller accidents in Texas and in Alaska, which showed to us that the company had a lot of environmental policies, but didn't seem to manage their ESG risks well. And this 40% underperformance after the incident wasn't just limited to that 1-2 month period afterwards, because people will often also say, well, you know what, markets tend to overreact and underreact, and then if you buy after this blow up, it might be a very good entry point. But in the case of BP, that was not so. For the next 6 years, BP continued to underperform other oil majors like Exxon, like Shell, like Chevron, and that's not a surprise to us, because if something so serious happens to a company, it takes up all the energy of management to steer the company back to the right course. And the company might be forced to sell off assets at suboptimal prices just to get the money needed to pay for the damages. So, and academic research has I think, confirmed this as well. Focusing on avoiding ESG risks can really help your portfolio performance. So that's one end of the equation. But of course, as sustainable investors, we like to have a positive mindset. So we're also looking at sustainable opportunities. So which are the companies that are able to benefit from sustainable trends and sustainable approach that we see in society? And if you look at the energy sector again, of course, a clear example is clean energy. And we've been looking at that clean energy for a long time as investors, but we tended to steer away from it. Because, for example, if you look at the solar industry, it was there were a growing number of companies. We saw it on more and more households, even in the Netherlands. But for shareholders, the returns were often terrible, because we weren't able to find these quality companies that were really able to structurally make money out of it. And I think clean energy is a nice example of an area where you've really seen the dynamic change, thanks to a dramatic shift in the cost of clean energy versus traditional energy, and the start of companies on the stock exchange active in the solar industry with much better technology, much better intellectual power, and also more pricing power. In our portfolio at the moment, and we've had that for a couple of years, you can find companies that are investing, that are producing solar inverters, that move the electricity from the panel to the grid. And unlike these solar panel producers, which are mass producers, where they have a lot of price competition, this is a unique technological area where you can really make the difference with better products and get higher margins. And that's where it becomes a much happier story for shareholders as well. So in our approach, we look for quality, and we're trying to mitigate these ESG risks and find these ESG opportunities where we can. Of course, applying fundamental analysis, because we really want to get to know the companies that we invest in, and also being active investors. Because I think compared to 10 years ago, also companies are much more used to equity investors really challenging them on how they manage the ESG risk and opportunities, and seeing where they're trying to make the difference and where they're trying to secure their long-term success by doing so. So to sum up, I think sustainable investing, really the message that we're trying to give today is really not just a niche, but really a very sensible way to invest equities from a general sense. And if we all do that, then maybe we can also save my house.
How about you, Oscar? You also are portfolio manager of equities. How you see that?
Sure. I think the story for Impax Asset Management started from almost 25 years ago in London. So the company was founded in 1998 in London. From then, we dedicated all our effort and resource trying to identify attractive investment opportunity to generate alpha for investor. We believe companies, and they provide solutions, products, facilitate the transition to a more sustainable economy, will experience much higher growth. Hence, we believe they are a better investment opportunity set for us. So we believe the financial market will be materially shaped by the challenge we face. So be it climate change, pollution, resource constraint, social issues, including demographics and equality, diversity, inclusion. So all those human challenges we face, they actually create business opportunities. We believe if company, they can help to address those issues during this transition, they will be the winners. So we spend a lot of time trying to map out the investment opportunity set there and generate superior returns for investors. And I joined Impax in 2011. I managed Asian strategies for Impax based out of Hong Kong. It has been quite a journey. Things change a lot globally, but also in an Asian context. So I'm very pleased to be here to share our stories with you today.
Great. And talking about when you started and how is the market now, Guido, can you comment how the market changed so far since the very beginning, since you started to work with sustainable investments, and now what changed in terms of investments and investors?
Yeah, no, I think it's been an incredible journey. And as you can see by my hair, I've started quite a while ago. And I launched my first sustainable equity fund in the Netherlands in the year 2000. And at that time, in our company, we were in a little corner at the far side, far away from all the sort of the mainstream equity products. And if you look at the data that we had available, we just had the first ESG data providers launching, but data sets were really limited. When you talked about sustainability with companies, they didn't really know what you were talking about. But the start was there. And we had a dedicated group of starting investors, which at the time were mostly foundations, which were some of our launching customers, and some of the retail investors who it was really important for. And well, if you look at the last 23 years, what has happened in terms of ESG data availability, there's so much to choose from that it's hard to pick the right from wrong there as well, but it's a different set of problems. But also the industry as a whole, there's all these industry unions where we can work together, such as the UNPRI. The industry is talking more with more voice. Regulation is taking a limelight, which is good in a sense because it puts more emphasis on the importance of looking at ESG risks and opportunities. And it can be bad because sometimes, and especially in Europe, I think the regulation can be a little bit strangling. But yeah, it's been growth. And looking at the investors, we're really seeing that from this starting group of foundations and retail investors in Northwestern Europe, it's really spreading around the world and to all client groups, and that's great to see.
Great. And what clients and regions are driving this growth in sustainable investments? Because we saw, the growth of this market in the recent 10 years, especially.
Yeah, I think from the original of us, I think you probably guessed, so from Europe and UK. So I think definitely Europe has been taking a lead in developing the regulatory framework, and investors, especially sophisticated institutional investors, they've already incorporated sustainability investing into their mandates from a very long time ago. So it's quite a mature market. They have a very deep understanding on what they look for. But that said, we've seen very strong momentum in Asia as well over the past few years, starting from again, institutional investors, especially the sovereign funds. They have their own kind of a green sustainability mandate. They're trying to also facilitate, help their nation to achieve their carbon emission commitment. So from that perspective, we've seen quite strong interest in the more developed part of Asia, for example, Japan, Australia, but to a certain extent, China as well. So definitely seeing quite strong interest there. Again, we have a quite big presence in the US, North America as well. Despite has been quite kind of politicized lately on ESG, sustainable investment, but I would say there is still very strong base and support that investors, asset owners, they recognize sustainability investment is the way to go.
And I would raise this question for you too. What are the themes that you find out that they are the key opportunities now for you, your funds, and also for your clients?
Well, if I look at in our Global Sustainable Equity Fund, we try to have a core approach where we are exposed to pretty much all the sectors in the MSCI World Index. But we do like a number of sustainable themes because we see they are growing much stronger than the economy as a whole, thanks to regulation moving in the favor and changing client preferences and sometimes big investment programs. And a clear one, of course, which has been in the limelight for a number of years and will probably continue to do so, is clean energy. Despite the rally in fossil fuels last year and the latter half of 2021, I think that the real strong growth numbers are still in clean energy names. And that's also an area where government investment programs, like the ones we've seen in the US, in Europe, but also in China, can really drive the market forward a little bit more as well. Other themes that we like in the portfolio, which is actually the biggest theme at the moment, is sustainable healthcare. I think in a society where most developed countries, society is aging, and people are getting older, and they need more health, and typically healthcare costs are increasing faster than the economy as a whole. So something needs to give, and in the sustainable healthcare theme, we're really trying to look for companies that are able to have an innovative approach, therefore lowering healthcare costs or improving outcomes at the same cost. So this is really the angle we play there. And I think the last one that I'd like to mention is also that's getting more attention as well, is the circular economy. So, and again, there we see more and more regulation coming up when it comes to reducing waste and recycling more and more. And one of the stocks in our portfolio, for example, is a market leader in reverse vending machines, and that's really they can just sit back and wait for yet another country to increase or introduce that type of legislation, and then they will typically pop up as a supplier because they have market-leading technology. So these are sort of the type of themes we play at the moment.
I think what we've seen is human society has been, especially after the industrialization, human society has been operating under a mode of kind of a resource depletive operating mode, where we produce a lot of negative environmental externalities during kind of our day-to-day life. That's not sustainable. That creates a lot of challenges we mentioned earlier. So what we've seen is actually in the past few decades, technology has been at the forefront of both the challenge but also the opportunities. For example, plastics. Since we invented the plastics, it's lighter, it's cheaper, it's been widely used, but it also creates a lot of environmental issues. But on the other hand, technology, innovation can help us to develop new materials, new solutions, recycle, replacement of the current materials. So we have technology there to resolve those challenges. I think what we're trying to capture is really the business model. The winners, during this transition process, they will experiencing much higher growth. They have a stronger business mode. They have a stronger pricing power. They would be able to benefit from this transition. And over the past decade, I've definitely seen, especially in the Asia context, the investable universe of environmental market has expanded dramatically. So in the old days when I started, was mainly driven by hard infrastructure related, wastewater treatment, water supply, metro, railway. But nowadays, you see a lot of innovative technologies, products offering come out of Asia. That's really driving the overall kind of value curve upgrade for the region as a whole. So I think that's really kind of new, emerging business models, opportunities we find really interesting.
Okay, great. And how do you decide if a company is or not sustainable? How you mentioned as ESG data. Later we will go to this question. But how you decide if a company is or not sustainable, and if you could add as well, it would be great.
Yeah, no, I mean, I think that's an interesting area where of course, this has been the key of our investment process for the last 20, 25 years. Okay, where do we cut the line? What do we think is really sustainable or not? And in the last 3-4 years, we're really seeing that regulators are wading into it as well with their own set of demands and constraints, and letting aside that, and then really focusing only on sort of the philosophy that we have. We are looking for companies with sustainable business models. And as I said, these are companies that have a long-term future in mind and long-term success, and also, indeed, long-term careful management of the world's resources. And these companies with sustainable business models, to us, it consists of 3 different elements. So we like companies to offer the sustainable solutions that we discussed, the type of themes and in products that can really help solve some of these sustainability challenges. And that's also where you see close alignment with the Sustainable Development Goals, for example. And so that's an important part of the portfolio, but it's not the full portfolio at this point in time, because we also want to offer a broad market portfolio that is able to do well under a variety of market circumstances. But what is absolutely essential to all the stocks in our portfolio is the next step, and that's sustainable behavior. So companies really need to manage any ESG risks and stay away from big ESG controversies in order to be good long-term shepherds of society, of the world. So for all the stocks in our portfolio, they need to show sustainable behavior. And if there's areas of doubt, typically in our engagements, that's what we focus on a lot. This is also something that's very material from a financial perspective as well. And then finally, and that's also key to all the stocks in the portfolio, they need to have a sustainable competitive advantage. So they need to have a clear edge versus other companies in their sector, so that they don't just have a sustainable product and good behavior, but there's also a reason for clients to engage with them and to buy their products in the long run. And if that's there, then you're able to sustainably create value in the long run. And we think that's the way to be financially successful and still making sure that the world stays a nice, livable place.
Great. How about you, Oscar? How you decide that?
Yes, so over the past 25 years as a specialized active asset manager, all we've been doing is really trying to map out the opportunity set and identify the winners in the medium longer term. And with our kind of offerings, on one hand, we have the thematic offerings that we have in-house developed taxonomy classification system. So we have environmental classification system, social classification system. So they gave you a hunting ground for your investment ideas. And on the other hand, we also have the more kind of general, generic, what we call sustainable lens framework. It's also in-house developed. It's trying to identify both opportunities, but also risks. So it gives you a direction of travel where you find most attractive investment ideas.
Great. And some investors, sustainable investors, considering that the ESG accounting, some of them decide to divest from high-emitting companies as opposed to invest in companies that are reducing the emissions. How do you see that? What's your vision on that, and how you deal with that on your portfolio?
I think to start with, when you only look at gross carbon emission, it's a very simplistic view. So you have to take account the emission avoided because of their products or services, right? Otherwise, you end up with renewable energy portfolio. So we consider there are a lot of industrial companies. They are underestimated during this process because on one hand, during their production process, they produce CO2. But their products and services actually help their end users, customers, to avoid emission. So we have to take a more holistic view on who is polluting and where the pollution comes from. Mm-hmm. I think that's probably a better approach to this question.
Great. And Guido, you mentioned ESG data. I would like you to go further on that. And how do you decide which data to use? Because good ESG investments come with the use of good ESG data. And nowadays we do have several. And how do you choose that, and what you take into consideration?
Yeah, no, that's a really important subject indeed. And let me start by saying, and similar to Oscar, that it's just an input. And at the end of the day, you really need to process the data and interpret it in your own fundamental analysis to find the stocks that you think are sort of the potential winners. Having said that, the growth and quality of ESG data has grown immensely in the last 20-25 years, and we've got two clear market leaders with Sustainalytics and MSCI, with a broad suite of products and a very wide set of coverage, which is really helpful. At the same time, you already see that correlation between the data sets is relatively low. So it already goes to show that you really need to do your own work to see what's more important to you and what's less important. So instead of looking at the top line ESG scores, we're really looking at the underlying data points of providers like that to figure out, as a first insight, how companies are dealing with certain aspects. And I think it's good to have a couple of specialist providers next to these general ones, because what you see is that a lot of the ESG data in itself is a little bit backward looking, because it's based on company annual reports. So we've gotten a lot of annual reports in the last quarter, and typically that's reports viewing back on what happened in 2022, whereas we are forward looking as investors, of course. So we don't want to be looking in the rear view mirror, but really looking and how that might work out into the future. So our analysts play an important role in that, and the conversation that they have with management teams. But there's also specialist providers that might help signal those trends as well. And for example, we also work with a company called True Value Labs, and instead of basing themselves on company reporting and company questionnaires, they look at that online media, and not just the newspapers, but they've got millions of online channels all around the world. And what they do, they just look at trends. So they will have a baseline information level for a certain company, and then sometimes the news cycle of a company increases a lot, and then that's a trigger, and it might be good or bad. We don't know that yet, but at least it shows that something is happening with that company on an ESG level, and that's a quicker way of also seeing how that sort of can impact a company when it comes to certain material ESG factors. And what we've done, and I think that's similar to sort of the ESG lens that you mentioned, we've also built a corporate tool that incorporates a number of these ESG data sources to really try to assess a company's score versus peers and its momentum, to get a first insight for our analysts on which are the potential winners and which are the laggards in a certain space.
Okay. How about you?
Yeah, I agree, and I just want to add, emphasize, we do believe ESG is the process of doing ESG is more important than the results, say the score. Mm-hmm. When you look at the ESG scores provided by the third-party providers, they probably don't mean much to us because we're heavily relying on the in-house kind of ESG analysis framework, which is incorporated into our fundamental research process. The value, the beauty of that is really during the ESG analysis process, we have the opportunity to gain a deeper understanding about the company from different perspectives. And we do believe engagement is also a very powerful tool alongside of ESG analysis, especially in developing emerging market kind of a context. Disclosure tend not to be ideal. You always face this kind of situation where you compare nothing. So engagement from that perspective really gave you another layer of understanding. Even if they don't disclose things, but you have to speak with the company, understand what they've been doing behind the scene. Are they actually having those processes and doing those kind of right things, but just not disclose them? Or they don't have any awareness of those kind of key material risk, ESG risk they face. So which situation it is. And through the engagement, when you gave them the idea, how can you do better? What's the best practice of your peers? And why those issues are important to your business? What's their attitude towards your suggestion? Do they take it on? Do they think about it? Those kind of really adds value to our fundamental research to identify the quality of a company.
So you really engage with the companies, right?
Yeah, I think also what's really interesting in that point that you made, and where I see a big difference compared to, say, 10, 15 years ago, is that now when you engage with companies, management hopefully, actually has the answers themselves. And then 10 years ago, they would point to the right to their investor relations department or the sustainability department, and they would give the sustainable answer. But you could see it wasn't really embedded in company strategy. And now you see with the good companies that take it seriously, the top management knows what's going on from an ESG perspective and really wants to use that to improve the company business.
Yeah, normally the CEO is really on top of that, right? The CEO and the top executive levels.
Yeah, we like it a lot when they do.
Great. Oscar, can you give a brief overview of the difference between a sustainable company and an impact company? I mean, or if you don't want to go there, the difference between a fund that is Article 8 or Article 9.
Sure. I just want to start off saying now we have all those kind of labels of sustainable investing, ESG investing, green investing, impact investing. So they're all very confusing concepts. And you ask this question to the audience here, they probably gave you 1,000 different answers to how they think about them, right? But I can give you our take at Impax on how we think about this. So the starting point for us is really trying to generate outperformance. And we believe companies that they provide solutions, products during the facilitate the transition to a more sustainable economy will benefit. That's our starting point. And of course, because we're trying to invest in those companies, they are winners in this transition. They tend to produce positive impact, environmental, social, positive impacts along the way. So I think the starting point is different. The objective is different. So for us, is to outperform, generate outperformance. And when you talk about impact investing, I think a lot of people consider impact investing as doing good, doing positive things. That's the starting point. So it's very different, I think.
Okay. And how about the Sustainable Development Goals? I mean, do you take into consideration into your framework to do those type of investments?
You know, we think the Sustainable Development Goals are a great tool because this is really it was a first way for sort of companies and regulators and investors to speak the same language when it comes to sort of ESG topics. So we applaud the fact that companies try to show how their products and services might contribute to a certain SDG. Having said that, we don't run a portfolio which tries to optimize certain SDGs. It's not a thematic fund, but in our fundamental processes, we really try to identify which companies are linked to certain SDGs. And you often find that the alignment between the SDGs and some of our sustainable themes, such as sustainable healthcare and clean energy, is quite strong. So we do try to figure that out, because we do know that if the world is serious about solving these sustainable development goals, and to a certain extent they are, even though progress is always choppy and difficult, we know that a lot of money will be allocated towards them, and that as a group, these are sort of higher growing pockets of the global economy than the economy as a whole. So it's an interesting area from an investor's perspective as well.
Do you use, Oscar, the SDG goals?
Again, I think because our kind of focus has been trying to find companies helping to address those environmental sustainability challenges, so there is kind of a natural alignment to SDG goals. But UN SDGs, they've been only developed since 2015, so we started way earlier than that. And SDG goals, they have, I mean, it's very comprehensive. They have 17 categories. And some of those kind of categories, they're actually not private sector, the public sector for the government to achieve. And when you look at our kind of alignment to SDG goals of our products, they tend to be quite high. So we can report on revenue alignment to SDG goals, but those are really outcome of our portfolio construction, our investment decision, rather than drivers of our mandate. But overall, we have a quite high alignment in the revenue sense. So across our thematic listed equity strategies, they tend to be over 50% of revenue exposure alignment to SDG goals.
I see. And in terms of revenues and profits, I would like to begin with you, but then I would like you to add to Guido. If you narrow the universe of investments, saying that you are going to invest only in sustainable companies, in a way, are you giving up potential, returns, or not really?
The simple answer is not really, but let me explain. So the starting point is we believe our investment philosophy is really trying to identify those companies that they benefit from the transition and they experience higher growth. They have stronger business model. They tend to better in difficult times. That's where we're trying to invest. And those companies tend to outperform in the medium longer term horizon. So from that perspective, the whole point of being focused, trying to identify opportunity, is really trying to generate alpha, outperformance. And we believe being a specialist in certain sub-markets, you have the edge, you have deeper understanding, you have the thought leadership. You'll be able to identify the winner more successfully.
How about you, Guido?
Yeah, you won't be surprised that I fully agree with Oscar's statements. Yeah, we also believe that using sustainability to focus the universe, I'd rather say focus rather than limit, is actually a way to get better results. And we've been doing this for 23 years, and since inception we've outperformed the index, which is only a sample of N-1, but still I think it's a sign that you can outperform by using this approach in the long run. And I also think when you, it seems like for sustainable investment approaches, you often get that question, whereas in essence, active management is always about limiting your universe. If you're a high dividend investor, you're limiting your universe to the higher dividend paying companies. And then people really typically don't complain about, well, are you giving up opportunities? And I think that any investment approach that reduces the universe, but in a smart way, trying to identify more successful companies, is a very logical way to approach investing.
Okay. So coming back to the engagement, you mentioned that engagement it's a tool, or it's a way to work with the companies. How about the investors? I mean, do you also educate investors? I mean, Europe came forward in this trend of sustainable investments. Latin America, I mean, it's going there, but it's not there yet. You do this type of work also with the investors, showing the advantages and the trends and the changes in the market. How you do that?
Yeah, no, we're always very keen to sort of spread the word, and I think it's very important to help our clients explain to their clients what sustainable investing actually means, and that we're not forgetting about financial returns when we're focusing on sustainability. So we've been doing that for more than 20 years in Europe, but I've also been coming to the Latin American region since 2019, as it's more and more of a subject here as well. And yeah, we really like to stay as close to clients and distributors as we can, in order to get their perspective and to try to alleviate the concerns, and also to spread spread the information. And since it's such a fast-moving area when it comes to developments and data points and insights and regulation, yeah, there's always a reason to come back. Also in Europe, we still spend a lot of time educating clients on trends and stuff.
How about you, Oscar?
I think that's another piece of our important piece of our work. So on one hand, we're trying to, as a company, maintain our competitive advantage as being a thought leader in what we do, constantly be on top of the new emerging business model industries, trying to capture the investment opportunity. But on the other hand, it's also very crucial for us to work with our partners. So we have this partnership approach across different stakeholders. So clients, investors, obviously they are a very important part of this. For us to provide the thought leadership is also important, not just the products, right? So on one hand, it's really to work with potential investors, clients, to understand landscape, where we are traveling towards, what's the future, what's the outlook. I think it's very important to understand those big, high-level questions before they make investment decisions. Once the high-level questions have been resolved, then you come up with the right products. I think that's the way how we work through this.
Great. And coming back to the themes, you mentioned circular economy, solar panels, renewable energy, and this kind of thing. I would like you, I mean, if you could give example of a good investment that, or a good choice of investment that you guys had to set an example for the audience, or a bad example that you are not going to do it again.
Sure. I mean, for us, due to compliance reason, I will not be able to give you stock-specific answers, but I can talk about, for example, industries, right?
Great.
So over the past decades, what we've seen, and this also comes down to my earlier point, Asia has been really driving the kind of technology innovation. It's not only about invent a new technology. It's also about lowering the cost to make it financially feasible for mass application. So solar energy, EV technology nowadays, they are probably good examples. Over the past 10 years, solar module cost has been brought down by over 90%. That makes the technology cost competitive. That's how you achieve grid parity to compete the traditional coal-fired power. An EV battery, we're looking at very similar trend nowadays. The cost has come down dramatically, driven by both on kind of the battery formula R&D, but also the production process innovation. So we are seeing kind of very strong growth in penetration rate of EV led by Europe and China. I think that really reflects on there will always be new technologies for us to resolve the sustainability challenges. So for us, it's very important to identify those technologies at early stage and have a view on how this technology will evolve. What's the application for end market? So those, on top of that, policy is very important, especially for kind of renewable energy, EV application. So that's a also important piece you need to keep top on. With all those kind of consumer preference change you talked about earlier, so you have to take a holistic and forward-looking view to be able to identify appealing investment opportunities.
Okay, great. Guido, what about the challenges of sustainable investments? Can you elaborate a little bit more on that?
Yeah, well, I think if you look at the ambition of sustainable investing, it's quite huge, and it's of course it's essential to the world. And at Goldman Sachs, we fully subscribe to that, and we're trying to take a leading position as a company as well. So on the one hand, as a company, we're trying to lower our impact on the world by reducing our carbon footprint, reducing our resource use, investing in underserved communities. And in order to increase our impact, because I think if you want to tackle these challenges, a lot of times the owners has put us as clients. So we need to change, or as consumers, we need to change our consumer preferences. But it starts by regulators creating the environment, and then the companies taking the step. And for us as a company, what we're trying to do here is that we set up a very ambitious program at Goldman Sachs a few years ago, where we're trying to dedicate $750 billion to the two most important themes that we recognize. So climate transition and inclusive growth. And we're doing that by channeling our own assets partially to it, but also dedicating client assets towards it, trying to get more client assets in these type of products, and on the advisory side. And I think with these type of numbers, you can really try to make a change and significantly help address some of the challenges we see.
How about you, Oscar? the challenges?
Well, the challenges, I think, as I mentioned earlier, we face kind of a lot of challenges that we have at high level. We have some consensus globally. For example, climate change, environmental pollution, resource deficit, social kind of challenges I mentioned earlier. But there are also challenges that we have very polarized view and we're not agreeing on.
True.
I think those areas that probably requires a bit more attention. So from our perspective, it's very important to have a more kind of holistic view and identifying not only the hot, debated kind of areas, but also trying to capture the trend which has not been kind of agreed at a public level or high level consensusly. So I think as a region, Asia Pacific, we face even more severe challenges compared to global average, given we host more than half of the global population, and it's still growing very fast. And the natural resource deficit issue is even more severe, especially when you look at on per capita basis. The most basic, meeting basic need things, you may not have safe drinking water, blue sky, clean air. You don't have those things in some part of Asia. So we are on one hand trying to deal with those kind of the basic challenges, but on the other hand, we're also facing, for example, fast, rapid aging population, equality, diversity challenges in the region. So you have to make sure people have basic access to, for example, finance, access to basic health care, education. So all of those challenges we face, we do believe there are business, they are in a very strong position to provide product solutions to help us address those challenges.
Okay, great. Well, it's been a great discussion. I liked it a lot. I hope you guys have enjoyed so far. Thank you so much for being here and for your presence.
Thank you.